The UK property market since Brexit, what buyers should know. Since the Brexit vote in 2016, the UK property market has experienced significant changes. Initially, the market saw economic uncertainty and fluctuations. Property prices in London and the South East dropped by about 1.5% in the year following the referendum. The British pound fell sharply, which discouraged foreign investors, but later created opportunities due to favourable exchange rates. Uncertainty led to reduced transaction volumes as both domestic and foreign buyers adopted a wait-and-see approach. Despite this initial instability, the market showed resilience with notable regional variations. While the prime London market, reliant on foreign investors, was hit hardest, cities like Manchester, Birmingham and Edinburgh showed growth due to rising demand for affordable properties. Brexit has driven several policy changes affecting buyers. Immigration policy changes led to labour shortages in construction, impacting housing supply. New rules potentially reduced demand for prime city properties by affecting international professionals. Non-UK residents now face a 2% stamp duty surcharge since April 2021, while first-time buyers receive greater incentives. Taxation changes include capital gains tax for non-UK residents selling property, impacting foreign investment, and reduced returns for buy-to-let investors due to changes in mortgage interest relief. New trade rules led to delays and increased costs for importing construction materials, and labour shortages have increased construction costs, affecting property prices. For buyers, opportunities include favourable exchange rates for foreign investors and advantageous conditions for first-time buyers through schemes like Help to Buy. Regional markets like the Midlands, North of England and Scotland offer affordable opportunities with growth potential. Challenges include higher transaction costs due to stamp duty surcharges, supply chain disruptions affecting housing supply and prices, and labour market uncertainty impacting rental demand. To navigate the post-Brexit market, buyers should conduct location-specific research to identify growth areas, budget for higher costs, and seek professional advice from estate agents, tax advisors and conveyancers. Government support includes the extended Help to Buy equity loan scheme and the 95% mortgage guarantee scheme, which encourages lenders to offer higher loan-to-value mortgages. Although the stamp duty holiday has ended, it improved market confidence during the pandemic. Future trends include a shift from city centres to suburban and rural areas, growth in the build-to-rent sector, and increased demand for environmentally friendly homes. Regional markets in the Midlands, North and Scotland are expected to continue growing, while London's prime market is predicted to gradually recover. Government efforts to stabilise supply chains could ease construction delays, improving housing supply. In summary, Brexit has reshaped the UK property market, presenting challenges and opportunities. Informed buyers who navigate these changes carefully, considering regional trends and professional advice, can find unique investment opportunities in the resilient UK property market. Landlords are said to be holding Parliament hostage over the threat of selling up, as peers are urged to rescue the Renters' Reform Bill. Landlords have been accused of holding Parliament hostage with threats of selling their properties to prevent the strengthening of tenants' rights. This controversy emerges as the Renters' Reform Bill heads to the House of Lords for its second reading. The National Residential Landlords Association, NRLA, analysed government data and found that in the last half of 2023, 45% of those needing homeless prevention support cited landlords selling their property as the reason. This is more than double the next common reason, which is reletting the property. Additionally, Rightmove's data indicates that 50,000 rental properties are needed to return to pre-pandemic supply levels. The NRLA argues that landlords need confidence to stay in the market and cautions peers against enhancing the bill to provide renters with more rights, after MPs had already diluted it. Generation Rent, a campaign group, claims the NRLA is cynically leveraging concerns about landlords selling to influence Parliament. Ben Tomey, chief executive of Generation Rent, argues that long-term landlord sales don't significantly affect the housing market, as properties remain and can be bought by other landlords, first-time buyers, or repurposed for social housing. Tomey highlights the lack of tenant protection when landlords sell and suggests incentives for selling homes to existing tenants or with sitting tenants. He also proposes preventing property sales within 2 years of a tenancy start and offering relocation relief for evicted renters to cover their last 2 months' rent while they find a new home. The NRLA cites rising costs and uncertainty over the Renters' Reform Bill as reasons for landlords selling. This legislation, intended to balance power between renters and landlords, has faced delays and controversy. The government has been criticised for watering down key proposals, such as the ban on no-fault evictions, which has been postponed indefinitely pending court reforms, seen as a concession to landlords. In London's superprime property market, Russian billionaires are out and US billionaires are in. London's superprime property market has evolved significantly in recent years. Timur Kulibayev, a Kazakh billionaire with ties to the former president of Kazakhstan and a fortune from his role at Gazprom, recently sold 2 mansions on Mayfair's prestigious Upper Grosvenor Street. One of these mansions, bought for £35 million by Northwind Capital, had been empty and deteriorating for about 20 years, reflecting changes in London's high-end property market. Stuart Bailey of Knight Frank notes that the market has been in a downward cycle since 2015, with prices down 16 to 17%. Brexit, the pandemic and high interest rates have contributed to a slow decline. Before these events, London was a prime destination for global high net worth individuals, with a 63% increase in superprime transactions between 2007 and 2014. The UK government sanctions on wealthy Russians following the Ukraine invasion further impacted the market by seizing properties worth an estimated £800 million. However, Russian influence in London's property market had already been waning before 2022. Now the focus has shifted to buyers from China, the Middle East and North America. Luxury estate agent Beecham Estates reported that US buyers accounted for half of all sales over £15 million in 2022. This trend continued into 2023, with significant interest from Middle Eastern buyers, driven by high oil and gas prices. The most sought-after areas remain Mayfair, Belgravia and Knightsbridge. The preferences of ultra-rich buyers are also changing. There is now a higher demand for large, newly refurbished single-family homes, while high-security lateral apartments in new developments remain popular. This shift explains Northwind Capital's interest in redeveloping Kulibayev's property. In summary, London's superprime property market is experiencing a transformation. With Russian influence declining, American and Middle Eastern billionaires are stepping in, reshaping the landscape of high-end real estate in the city. Real estate trade associations have endorsed the launch of the Reserved Investor Fund, RIF, a new fund structure expected to be available later this year. This support follows the end of the government's consultation on draft tax regulations. The RIF, designed for professional and institutional investors, will be introduced through the Finance Bill and aims to facilitate investments in commercial real estate, social and affordable housing, town centre regeneration and green infrastructure projects. Melville Rodriguez of Apex Group, who spearheaded the RIF initiative, highlighted the fund's potential to attract UK and international capital, reducing the financial burden on the government. The RIF will be domiciled onshore in the UK, featuring a transparent tax status, making investors liable for tax on the income according to their own circumstances. Paul Richards, CEO of the Association of Real Estate Funds, emphasised that the RIF will provide streamlined access to projects that support UK economic growth, housing and sustainability. Rachel Kelly, of the British Property Federation, stressed the importance of making the RIF competitive with overseas equivalents, to attract a broad range of investors, addressing key challenges like net zero targets and high street regeneration. The Duke of Westminster's £10 billion fortune has sent him to the top of the young rich list. Hugh Grosvenor, the Duke of Westminster, has topped the under 40 category of the Sunday Times rich list, defying the property slump with a fortune of £10.1 billion. At 33, Grosvenor is 15th on the overall list, down from 11th in 2023, and now the third wealthiest person in the northwest of England. The annual list, which ranks Britain's wealthiest individuals, was topped this year by tycoon Gopal Hinduja with £37 billion. Grosvenor's wealth has risen from £9.9 billion in 2023, highlighting his resilience amid a challenging property market. Set to marry Olivia Henson at Chester Cathedral this year, Grosvenor is a godson of King Charles, a close friend of Princes William and Harry, and godfather to Prince George. Despite a downturn in London's commercial and retail property sectors, the Grosvenor family has largely escaped the worst impacts. Their 2022 accounts reported nearly £5 billion in assets, an increase of £200 million from 2023, with dividends rising to £51.1 million from £49.9 million the previous year. The Grosvenor family, with ties to the Romanovs and Russian writer Pushkin, owns an extensive property portfolio spanning 40 cities worldwide, including significant estates in Lancashire and Scotland. Their holdings range from locations in Bath and Liverpool One to London's prestigious Mayfair and Belgravia. Grosvenor inherited his wealth and title following his father's death 8 years ago. During the pandemic, he donated £12.5 million to COVID-19 relief efforts. He continues to work with a charitable foundation focused on young people and serves as the chairman of the Grosvenor Group, a prominent property and investment company.